How's it going, YouTube? We're back here, Mikkel Hayden, with another Finance Friday video. We're going over some interesting stuff, so let's take a look. First thing up is Basel III Endgame. What the heck is that? Well, we're going to dive into it and see what kind of impact it's going to have on us. And let's take a look at this article. So this new regulation named Basel III Endgame is in part a regulation for banks to be required to hold more capital to protect against future risks. Now, this type of regulation on banks would have all sorts of unwanted impacts on not only the market that banks are a part of and the economy surrounding those, but also small businesses and households of really any size across the United States. Specifically, this regulation would require banks to hold capital at an increased rate of about 25%, which would take money out of the economy in a way which we can talk about a little later. Now, this new rule is going to affect banks that are holding over $100 billion in assets, and they will have until the year of 2028 to make this happen. So really, what are the potential impacts of this new regulation? Well, first of all, it's going to be taking money out of the economy and making the banks hold on to it. This will make mortgage loans and other small and big loans more difficult for people to get their hands on, as banks won't have as much capital that they're allowed to give out. And this will likely decrease savings account yield earnings, as banks will be earning a little less and therefore they can only give out so much money to these savings accounts. On top of that, a handful of the CEOs from some of the big banks that this would affect are pushing back against the regulation, saying that it will cause people to look for other sources of ways to get loans or other money that they need for purchases, and these sources could be unregulated. If people do start to go to these unregulated sources for loans or ways to acquire money that banks can't offer, then regulators will be in the dark and not be able to kind of see the big picture of what's going on. I'd say the big thing here is that as banks need to hold on to more capital, they are taking money out of the economy. When people put money into the bank, they're able to then lend out most of that money to other people, making it seem like there's a lot more money in the economy than there really is, which is good for the economy. As people can start businesses and other ventures, offer labor to people that benefits everybody. And if the banks aren't able to lend out as much money, this could shrink the economy a little bit and slow things down, which isn't ideal. Of course, it's hard to say how this will affect the everyday investor, but generally taking money out of the economy and holding it where it doesn't get used isn't going to be super helpful, and it's not going to help things grow. So there's likely to be several of these negative impacts, and we're just going to have to see what happens. Now we're going to go over some investing advice from this article that goes over some of the ideals of Charlie Munger, who recently passed away last month, but who was one of Warren Buffett's longtime business partners. And together they made big strides and gave a good example of what investing can really do for us, as everybody knows Warren Buffett is one of the wealthiest men on earth. Now, in a somewhat recent podcast, he said the following: I only study two kinds of companies. I'm enough of a big Ben Graham follower, so if something is really cheap, even though it's a crappy company, I'm willing to consider buying it. For a while, anyway. I do that occasionally. I've done it with great success a time or two, but unlike Howard Marks, I've only done it once or twice in my lifetime for big gains, and that's it. Now, this mindset and idea comes from Ben Graham, and it's the idea that you invest in things based on value. It doesn't necessarily mean you throw money at cheap stocks, but you rather look for stocks that may be undervalued or overlooked, but have good ideals and a good foundation from where they could possibly grow in an enormous amount. Investing in startups can always be a little risky, but on occasion, Munger says they can pay off in big ways. And it's always good to look for companies that are creating that value and have a good business ethic or good ideas that you really believe in. But the bottom line is to just look for the value and it could pay off. And also, to that point, when investing in any company, whether it's a startup or an already established big company, it's good to look at what their values are and what kind of value it brings to the economy, as that will be a good indicator as whether or not you will get good returns on your money when investing in their stock. If it's a good company, then they're almost always going to go up in value, and you're not going to make any bad investments if you're putting your money into them. This next one is an interesting one because it's about personal finance classes in school before college. Now, I never had the opportunity or option to even take a personal finance class until I got to college. And by that point, I was already in need of knowing how to manage my personal finances, and I hadn't had that education ahead of time. Apparently, a lot more states are beginning to implement new laws and regulations that will require high school graduates to have taken a personal finance class before they graduate. And this is reaching about 23 states now that are either implemented those classes and requirements already or are going to here in the next year or so. These 23 states are receiving an A from the national advisors that rank how well schools perform at offering certain education. So for personal finance, these states are getting that A grade, whereas other states like California, where I grew up and was going through high school, are receiving an F, meaning they're really not implementing anything nor even trying to teach personal finance in classes. A director of Chaplin's College Center for Financial Literacy said, "Once you graduate from high school, not a day will go by that you don't think about money. How to make it, how to spend it, how to save it. You will be thinking about this until the day you die." Because of this, I think it's really important and really cool that schools are starting to implement this so that the younger generation can learn before they need those skills how to manage their personal finances and make smart money choices. And with that, I think the younger generation participating in these classes in school is going to help out the economy as a whole, as all of us are part of every interaction and transaction that goes on. If more of us are making smart decisions, it's just going to help everybody together. And studies show that learning personal finance early on helps in a myriad of ways, such as an increase in credit score or a decrease in loan delinquency or payday lending. I think this is going to be a great change, and we're going to see the effects of it here in the future as those younger generation grow up with that education and start to participate more and more in business and any other aspect of the economy where people are working together and making smart money decisions. Anyways, thank you guys for coming and watching today. I hope you guys enjoyed it and are excited to see next week's video. If you're not subscribed, please hit that button so you don't miss out, and hit the like if you enjoyed this video, and I'll see you guys next time. Thank you.